don't understand something. This is like super relevant. Like I just finished kind of doing a bunch of the research for this today. So I may forget some stuff, so I got my notes. Because the market's like changing super fast right now.
Is anybody a note taker, wants a handout and a pen?
Vicky does.
I'm a still trap.
Not me.
I'm old school. I'll take
Except when it comes to upgrades.
Yeah.
I forget putting gas lines in walls.
I'll take that. Thank you.
It was bad today. Missed like 5 of them.
Thank you.
Yeah, it was really bad.
Thank you. Thank you.
Yeah, so I'm using this is my new whiteboard. This is like my new favorite toy. So we'll be using that a lot. And then we can save the notes on it too, so we'll be able to export those. So Kat is kind of the boss. So get her your info if you want anything else. She can send the slides, kind of whatever. We need Autumn, huh? So yeah, this is about inflation, housing bubbles, and how to prepare. You know, as you guys all know, things are changing pretty rapidly. Interest rates were in the high 2s. Now they're like in the mid 5s. So we'll go over some math on how that affects buyers and sellers. And then also the differences between this housing market and the last one that crashed in, say, 2008, 2009. And hopefully you guys get some good data out of it. And then again, feel free to stop me at any point. Yes. So the first question is like, what is inflation? So we calculate inflation by having a basket of goods and comparing the cost of that basket of goods over time. And oddly enough, the basket of goods is cereal, milk, coffee, chicken, housing, clothes, medical, recreation, vehicles, airfare, education, and televisions. So basically what they do is they say, if I'm a shopper and I buy all these goods in 1970, 80, 90, 2000, to 2020, how much does it cost? And so that's called like anybody ever heard the term CPI, Consumer Price Index? So that's what that is. They say, okay, this same basket of goods over time is increasing in cost, and that's inflation. Another thing I like to use is you have a dinner party at your house and you've made cheddar chowder for 10 people. My mom makes amazing cheddar chowder. And what happens is 14 people show up. So you're like, okay, well, I made enough for 10, so I knew that I could have 10 full bowls, 10 full tummies, everyone's happy. Now, I don't have time to make more, so I'm adding a little bit of water to the soup. So now it's in a little salt, so it tastes okay. And now you have enough for 14 bowls. Dan, the chef over here, is horrified. But what happens is they all have their full bowls, but they're not totally full, so they go back for seconds and there's nothing left. So that's what the federal government has done with our monetary supply. PPP, right? Paycheck protection, emergency disaster loans, bailouts, grants, and one of the biggest ones actually was the enhanced unemployment, right? Where people were making more not working during the pandemic than they were working. So what we did is we poured a bunch of water into our dollars, making our dollars less dense, so it takes more dollars to buy things now. And we can measure that by this basket of goods. So this basket of goods is more expensive today, so it takes more dollars to buy the same things than it did a couple years ago. And that's essentially what inflation is in a nutshell. Who's got the slides? You do?
Ready?
Yeah. And then definition of inflation is the decline of purchasing power of a given currency over time. And then we've also had some periods of deflation where they took water out of the soup, so dollars bought more one year than they did the prior. A good example of that would be 2008, when in 2006 it took, say, $600,000 to buy a house, and then 2 years later it took $300,000 to buy a house. That was considered deflationary. We're not seeing that happen so much, and I don't think we're going to see that again, but those are like the actual examples. What's the next slide?
Crops.
Yes. And so this gets into what kind of inflation we're looking at. So we know we've got money supply policies, right? That's all the money that the Fed's pumped into the economy and all the other countries in the world too. And that's why you notice the dollar's still relatively strong to other currencies because they all did it. They all added water to the soup, which was the easy fix instead of making more. And then we also have, with the paycheck, the enhanced unemployment, what happened is people were disincentivized to work. So now, if I run, say, a Supercuts, and my hair people make more money not working, or the same amount of money not working as they do working, I have to pay them more to get them to work, right? And then if I have to pay my people more, I have to charge more for a haircut because now my margin's been pinched. And then if I charge more for haircuts, then the people that are getting the haircut have to bring more dollars in. So they, whatever their prospective business or income is, they need to make more money. So they ask their bosses for raises or quit. And so it spools up. And so that was like one of the biggest things that hit us that was an unintended consequence of this unemployment benefit was there was a ton of people that were disincentivized to work. So that's one of the big things that we need to look at is how do we incentivize people to show up to work? Welcome, tiny guy.
Hello.
Everyone, that's Logan.
Hello.
World's smallest real estate agent. All right, what's next? Does that make sense?
Yes.
Like kind of what, and that's what we've experienced, and it's kind of across the board. You're making $1,000 a week, not working. I mean, then the question is, what do you need to make working for it to be worth it? It's not $1,100. And then what's funny is, so we're right now they're saying inflation's about 8.9%. Has anyone else seen that number, something close to it?
Mm-hmm. Yep.
That this basket of goods does not include energy, right? Energy is fuel, right? That's diesel that goes in the trucks that deliver stuff down the highway. That's also the same diesel or petroleum based that gets them across the ocean, that gets the airlines moving. So if you were to actually add in the cost of energy, natural gas, for natural gas fired electric production plants as well as heating your homes, it's closer to 20%. And so that can be a pretty staggering number. So that means that if you can buy $100,000 worth of stuff today with $100,000, next year you can either spend $120 to get the same thing, or you got to take stuff out of your basket. So the money that's sitting in the bank is dropping in value precipitously based on this. And so this is what they're telling you, but this is the real one, right? Because I'm pretty sure everyone in here uses petroleum-based products. I mean, the chairs you're sitting in are made of plastic. Plastic is made from oil. So what happens is when the input costs go up, commodities, right? Oil, corn, soy, iron, when those things go up, everything else goes up. So we'll touch into that a little bit later as to how like you can hedge against it. And like pro tip, buy the stuff that's going up that's needed for everything else. Or like lithium for Tesla's batteries. Yeah, so great example, right? On top of kind of your standard stuff, monetary policy, we have things outside of our control like wars, right? The US is no longer energy independent, and we're buying oil from Russia. Russia starts beating up Ukraine. We stop buying oil from them. Oil shoots up because we just cut off a huge supply. And then the other people that have the oil are like, oh, this is fantastic. We can charge you whatever we want because you can't get it on your own. Next slide. This is inflation over time. So what you see here, this was the influenza pandemic of 1918 and the end of World War I. And then this right here, so pre-war, or during the war, post-war, influenza pandemic, and that was a real one. I think 50 million people died, and 1/3 of the world got it. It was sick in a bad way. This was the Great Depression right here from like 29 to 1935. And then to contrast that, like that was horrific, right? This is 2008. Inflation was just 0.9%. So we can tell that this was not nearly as bad as that. And I don't think that this is going to be anything quite like that. But if you just kind of look at trends over time, it's usually big inflation followed by deflation, because bad things happen with like super high inflation. So now if you were to actually calculate this like the way that a normal person would calculate it, what you're actually doing, now all of these would be double, right? Because they don't count energy, which is kind of interesting. And that's also why like we can send these slides. But that's one thing that you always do is we look at the past to predict the future. It's not going to be perfect because things are always a little bit different, but it's a pretty good indicator. Like what's happening now has happened before, right? We've had booms and busts in the real estate market, in the stock market, right? We saw a bust in 2020 and a big recovery because of all this monetary policy we did, and we're kind of seeing the bust from it right now. Who's in the stock market? Who's happy about it? I think I lost 25% like the past 2 months. Dave's like, what's the stock market? All right, what's next? Cat's probably mad because I added that one all by myself and didn't have any text around it. Any thoughts on the like inflation part or questions, or does that make sense? Okay, good. So next thing is why this market is not like the last. You go back to the last recession, money was very loose. Mike, were you lending back then?
Yep.
Were you getting pretty big incentives for like subprime Alt-A stuff? Were you doing any of that?
Don't admit it.
It was very, I mean, I've always been super uncomfortable. Back then, there was what they called rebate pricing. And so lenders would price on the backside of an interest rate what they wanted to make on top of what they were making on the front. And the consumers would not know what you were making on the back, which is super wrong in my opinion. But anyway, so that's just a small example of some of the stuff that went on.
What do I want to make?
Yeah.
On top of what I already made. So the next slide will go over a couple things and I'll add to it. So in 2022, who's bought a house in the past, like say 5 years? Did your lender make sure that you could repay your mortgage?
Absolutely.
Was it uncomfortable?
Yeah.
Did they take a DNA sample to make sure you're you? Right? They check your credit, they check your income, they call your boss the day before it closes to verify you still have a job. They ask you trick questions, they look at your bank statements. Like, they make darn sure that you can pay this mortgage, right? Rates are low, a lot of the borrowers are low risk. But if you reverse back to 2006, a little bit different story, right? So you had like your prime, right? And then under that you had Alt-A, and then you had the submarines. So these paid all the money. So prime is a good borrower. Like everyone that bought a house in the past few years was probably a prime borrower, right? Your interest rate wasn't 12%. You conform to most of it. Alt-A was pretty good, but maybe they had a bankruptcy or had a bad credit score but had good income. And then subprime was just riddled with problems, but they paid the most. You could get, like Mike said, right? You charge them a rate and then you can maybe charge more points to originate or whatever, because these people really shouldn't borrow. And I remember people buying houses and they could actually borrow more than the purchase price of the home. So the idea was you buy it for $500, but you get a loan for $550. Then you take the $50 and make the loan payments because you couldn't actually make the payment, knowing that it'd go up, and you sell it, make $100,000. Do you guys remember that? Anyone? I remember people doing that. I remember my dad built like a $700,000 house, and a dude that washed cars on one of Lithia's car lots bought it, making like $16 an hour.
Yeah, you just had to claim what you made.
Yeah, you'd fog a mirror, write down what you made, and then it'd go away, and that was your.
Yeah, that was Countrywide's Fast and Easy. We called it the Fast and Sleazy.
I'll write that down.
Keep in mind, I was not doing the loans. I was just making money.
I was selling.
I didn't do those either, Bruce. I just did
There was also, in 2006, I'm just gonna, oh wait, let's try this. Oh, yes. We also had 3.85 million homes for sale. Good luck reading that. And we had 650,000 new builds. Right, this was 6.5 months of inventory. In December 29, 2006, inventory was at record levels. Now, if you contrast that to today, in 2022, there's a total of 1 million homes for sale and about 285,000 new builds, right? So over here, you have almost 4 million homes on the market, and this was pre-crash. And over here, you have 1 million. So you have a quarter of the inventory in many less new builds. And everyone that owns a house right now has a low interest rate, and they gave DNA samples to their lender to make sure that they could make that payment. And if they don't make their payment, they go look to rent the same house that they live in, and rent is going to be significantly more than what their mortgage payment is. And if they want to go buy another house, they want to sell this one, that's got a 2.875% interest rate for $400,000. They're going to go buy one for 5.25, and it's $600,000. The delta here is massive. So like, forget it, I'm just not going to sell. And if people don't want to sell because it's more expensive to rent, and it's also more expensive to own the same house now. So if you have a $400,000 house, I think I have the math in here somewhere, at 2.5 versus 5.5% interest, it's a $690 a month payment difference, just in principal and interest. So in order for us to have like housing go down in value, we would need to have like this crazy amount of inventory, right? And for us to have this crazy amount of inventory, it'd have to make sense for people to put their houses on the market. Like say they couldn't make their payments, or they could find cheaper options renting, but we're not seeing any of that stuff in play. So is it a housing bubble? I don't think so. Probably more than what it is we're gonna go back to normal. You know, in the past few years as a buyer, it's been a nightmare. You know, especially for the real estate agents trying to help buyers, and then lenders watching real estate agents try to get their buyers into things. There's bidding wars. You even go up to Eugene, people are still writing offers for $100,000 over asking just to get a house. And that's not sustainable. Like that's considered red hot, and like anything that stays hot for too long goes bad, right? If you have a fireplace and you've got a fire rip in there, pretty soon it's gonna look like a jet engine shooting out of your chimney, gonna burn the house down. Like you just can't stay that hot that long. So I think what's gonna happen is, oh, there it is we're just going to get kind of back to normal. So this is the math. 2.5% interest loan. Oh, you guys can't see that, can you? So I'll preach to you, Dave. So a 2.5% interest, $400,000 loan was $1,580 a month. So a quick rule of thumb is for every 1% increase in the interest rate on a 30-year mortgage, it's about a 10% increase in your monthly payment. So it's $1,580 at 2.5. It's about $1,800 at 3.5. 2025 at 4.5. And in 8 months ago, you could buy a rate down to 2.5%. I look today's average across the board for a 30-year is 5.5%. So the difference there is $690 a month, kind of like I touched on earlier. But the other thing to consider with that is how that affects your purchase price, right? So we just said 1% increase in the interest rate is a 10% increase in your monthly payment, and that translates to about $127,000 in purchasing power. So if my budget's $1,600 a month for a mortgage, I can no longer buy a $400,000 house. I can buy a $273,000 house. So that's why we're seeing, we had on average in the US 7% drop in prices since the first of the year. And that's not housing going down, That's people that thought their stuff was worth way more than it actually was, and them getting realistic. Right? I mean, you look at Zillow on your house, it says $450, I've got to give $550. Neighbor down the road sold for $6. And then you find out, well, it's not a comparable house, and blah, 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 and also now you have to get more realistic. So this is what our buyers are feeling. And that's also why they're not going to be a bunch of people to go sell. So what we're concentrating on is new construction and then selling non-owner occupied homes. So if you own rental property, you're sick of owning rentals, it's a great time to sell because there's not a lot of people willing to go through the pain of selling. And the reality is, if I'm going to sell the house I live in right now, I need to get a hell of a lot more than it's worth to offset the high interest rates. Right? Like, hey, you better pay me a ton of money if I'm going to get rid of this thing because I'm going to get gutted on my next mortgage. What's next, Autumn? Speak.
How do you think things normalize if you still have high interest rates and nobody wants to put their house on the market?
So we had like a 19% year over year, December 21 to December 22. So 12-month period, 18.7% was the increase in year over year values.
Mm-hmm.
So like the normal real estate trend line is 4%. And that's typically kind of what CPI and inflation tracks to as well.
Mm-hmm.
But what we've seen with real estate was kind of this. And so this is like what we call a delta, or the difference between what it should be and what it is. So normal interest rates are 6-7%. Normal, so yeah, you have 6 to 7% for a normal interest rate. Who bought in the 80s? What was your interest rate?
Oh, shoot.
It was like 12%.
12, 13, 14%.
He's like, oh, sleep, dude.
16 maybe? I don't know. It was way up there.
Right? So it's 16%, then like real estate was like lower. So this is normal. And 6 months of inventory is normal. So we'll get to a place where buyers have options to purchase homes, and sellers may have to incentivize them a little bit. Like, hey, that place is a piece of crap, I'm not buying it. Well, fix the roof. Okay, maybe now. And you'll have to, so we're just gonna go back, instead of like 18%, which happened here, too hot, right? Gonna have a freaking flu fire, get back to normal, which will be like kind of a boring market is my best guess. So that would be my definition of normal. Does that make sense?
Yep.
Yeah.
Basically, people adjust they just realize that it's not going to be 2.5%. Yeah.
Yeah, so, gosh, I love this thing. So we're selling lots of houses. So this is 32020, right? People flipped out when the pandemic hit, the shutdown happens. What?
This kind of like
Sick. And then they got used to it. And so this is interest rates spike, and then you just get used to it. Well, maybe not that, maybe that. Right, so same thing, oh man, I could buy a $600,000 house, now I can only buy a $470,000 house. Forget it, I'll wait. And you go, well, maybe I shouldn't wait, because this is kind of the new normal. So people get used to it and adjust their expectations. Sellers get, home sellers get more realistic. And then, in a couple years, it's like, yeah, I got a 6.25.
Do
Damn
you
it.
want to continue on this slide or go back to the 2.7 trillion?
Mm-hmm,
Go back.
So this is like the one thing no one's talking about that I think is super interesting. So the reason we had such a crazy housing market and the reason we had such crazy low prices was called quantitative easing. So quantitative easing was where the U.S. Treasury was giving the Fed, which is the big bank, a ton of money to buy all the bonds off the market, buy all the debt at rates that no investor really was interested in. Like who wants to take $1 trillion and get 2% interest on it? Well, actually, I might give you a lot of money, right? When you can get much more than that in the market, right? I'm in the stock market. Stock market averages 7% a year, over the past 100 years. So the feds buy up trillions of dollars of this stuff. And check this out. You guys know what a trillion is? I screwed this up earlier. 2.7. One more? Seven zeros?
One more set.
That's how many doll hairs. That's a lot, right? And this is all at an average of about 3% return, or interest rate, right? Some are 2, some are 4, but its average is about 3.5%. And the Fed owns this. Now, rates are at 5%. So if I have $10 million, I can either buy this trash and get 3% on my money, or I can go get new loans and get 5%. Which one would I do?
5%.
I would get the higher one. Yes. So if you want me to buy this trash up here, what would I expect you to do?
Negotiate.
Drop the price. Right? So we have collectively $2.7 trillion in loans that the Fed is holding that the Fed doesn't want to hold. And the chair and the board of directors for the Fed, as well as Congress, is pushing them to start selling about $35 billion a month of these on the open market. Problem with that is we took $2.7 trillion out of the U.S. Treasury, and we're going to return significantly less than that. And if they sell too much of this, it's going to jack rates even higher, because investors are going to pay pennies on the dollar for that money, knowing that they could invest their money elsewhere and get better money. So it's like, okay, yeah, you think that's 2.7 trillion, but if I'm going to sell on the open market, maybe it's only worth 1.5. You get the point. It's worth a heck of a lot less, and that's how the bond market works too. Like you'll see interest rates went up, bonds took a dump, because everyone bought a 10-year bond at a 3% return, but now that same 10-year bond is a 5% return. So my 3% bond is worth way less money now, because I could go buy a new one and get a lot more money every month out of it. And so this is just a massive bond problem. But the issue is they've been buying all the mortgages that all the lenders have been originating. So the lenders get their money back and they can loan the money again. But if they stop buying them and start selling them, that is the one thing that could really screw us up. Because if they dump all this on the market, rates could shoot up to like 7, 8, 9, 10%. So this is like kind of like your caveat that no one, I don't know why anyone's not talking about this, because it could be a big problem. So as long as they don't do that, we'll be okay. But they did. Like, this is the cause of the boom. They bought all the money super cheap, and then it's just not going to work to then sell it for less than they bought it for, basically short selling all this money and subsidizing all of our stuff, and then kind of screwing the taxpayer at the end of the day, because that money needs to be replaced. So that's the one thing. And if you want to look it up, it was on Axios.com. It's a super interesting article. We'll pull it up on that when I'm done, for anyone that cares. Is that interesting?
I feel like maybe that's the thing that Johnny Depp's trial seems to be distracting us from, right?
Oh, is that still going on?
Yes.
Gosh, what a bunch of degenerates. Kind of sounded like fun, though.
I feel like I'm Team Johnny, though. So.
Oh, yeah.
Yeah, she was nuts.
I know, crazy.
Yeesh. So what's most likely going to happen? We're going to see sales volume drop, right? Kind of go back to normal again, like red hot. Let's get back to like a sustainable level. So sales volume is going to drop. I think there's a good chance that there's going to be a lot of contractors as well as real estate agents, anyone that's involved like in the housing industry, lenders are going to get slapped around a little bit. So the small guys, the guys that weren't doing a ton, maybe the guys that weren't doing it full time, weren't very good at it, are going to get removed from the industry. Very similar to what happened in 2008. Like there was a lot of people just got out because there was no money to be made in it. So it's not going to go away, it's just going to go down. And then I also think that the bigger ones, the ones that have a good war chest of money saved up, are going to do even better, because there's still going to be hundreds of thousands of people buying and selling homes every year, right? Because you buy when you have more kids, you sell when you downsize, people get divorced, people die. There's still going to be a lot of transactions happening. It's just not going to be this like rabid craziness. It's just going to get more to normal. Hopefully housing pricing stabilizes to 4%, which is that 4% trend line, which is what it should be. Because you've got to remember, like most stocks you buy aren't leveraged, but real estate is. You know, so with your 4%, you didn't put $1 million or $500,000 into it. Maybe you put $50,000. So you put $50,000 into a house, but it's bought you a $500,000 house. So you get 4% on the $500,000. So it's a leveraged amount of money. So we can do the math on that to see why 4% isn't really that bad. Because it would be, now if you had cash, that would be a little bit different, but mostly people don't. So your investment's $50,000, right? That buys you, because you're 10% down, that buys you a $500,000 house. Your $500,000 house goes up 4% a year, which would be what, $20,000? Is that right? Am I crazy? Yeah, close enough. I think it's right. Yes. So your 50 is making you 20 in equity, right? Which is pretty good. Or your 500,000 also makes you 20 and you have no payment. So if you're renting it out, you have a lot more cash flow. So that's really when it comes into play. Like in this scenario, if you have a $450,000 mortgage, I don't know, what was that, 2,000? Let's say it's 2,000 a month. And your rent is 2,500. You only make 500 a month if you have a loan, but then you make 2,000 a month, you know, kind of assuming taxes, all that stuff doesn't exist. So that's like if you're cash, you make more monthly, but if you use your down payment, you have better leverage, right? Because this would be like considered a cash on cash return is significantly higher, right? That's a big number. I don't want to do the math right now. 40%. So that's kind of what like a 4% market looks like. What we had, you know, historically with some ups and downs. Another interesting point, Mike, are you seeing much adjustable rates come back into play? Yeah. So adjustable rates were also a thing that murdered the last housing market, right? So rates are at 6-7%. You can't afford it, but you could afford it if it was at 3%. So you're 3% for your first year, and then maybe you're 4% for your second year, and on the third year it adjusts up to 7. You're screwed, can't make the payment, the house is worth less than you paid for it, dump it, foreclose on it. So what may happen is we may just be pushing this out. What's the typical adjustment period on an ARM? 3 to 5?
6 adjustment period as far as after it adjusts.
Yeah, so like the teaser rate to the real rate.
Probably like that. So I'll just be honest with you. I'm not seeing any of that. What you're talking about.
Where the jump.
What we're seeing and what's coming back. So, in my opinion, arms were used very predatorily used back in that era. What we're seeing now is what an adjustable rate should be used for, and that is longer fixed periods. So 5 years, 7 years, 10 years. And so I'll turn it back on you. What's the average turnover for people in homes or even in a mortgage? You know what it is?
5 to 7.
Correct. So how much risk is there in that? Then we get into, okay, so it's fixed for 5 years, 7 years, or 10 years, you choose. Obviously it's a lower rate at 5 years, so you're fixed for that period of time. Then you get into either every 6 months you adjust, or every 1 year you adjust. And then there's caps on it. So it can't adjust too much either, so there's a lot of safeguards in it. And the lenders now have to calculate all those things, so you cannot qualify at the rate of the lower rate of the ARM. You have to qualify at the what we call fully indexed rate. So there's safeguards in it, but it gets you in much lower. So what I've been talking to people about is if it allows them to get into a home and their income is going to go up and all these different things, chances are, not assuming it's going to happen, but chances are rates come back down once we hit into recession, because history shows us that that's what happens. Also, just another point while you're on the topic of what's gonna happen. Recessionary periods follow an inflationary period. Recessionary periods show us over history that appreciation at 3 to 4 to 5% happens during a recession of our house prices. Which is kind of cool information that I've researched recently too. So, bottom line is, chances of you doing a different mortgage, moving on, or whatever it is in that period of time is very highly likely. What was happening back then is
Jack them up.
they were, hey, don't worry about it. We're just going to refi you in a year or two. Don't worry about it. It's not a big deal. We'll just refi you. And then it plummets. That is not the appropriate way. You can't afford this payment, but we're going to go ahead and get you into it. And don't worry about it. We'll refi you in a year. Oh, wait. Prices went from 600,000 to 300,000, like you said earlier. Now we can't.
Yeah.
What's your alternative? Foreclosure.
So that's one thing we'll watch for. You know, obviously, like we learned from the past, but we get enough adjustable rate mortgages, like that's what we're going to see become more popular, and it can be a great solution if you still want to buy. And you know, you're gonna. Most people don't live in a house for 30 years. So what they used to do, collateralized debt obligations, mortgage-backed securities. What a lot of times they would do, and they still do, is they'll break up your mortgage into 360 payments. And so each one of these is a payment bucket, right? From 1 all the way to payment number 360. And companies used to a lot more, and they're doing it now again. They can buy a bucket, right? So the least likely payment to make, so maybe you buy 10,000 of these, and there are 1,000 payments, right? So this is worth $1 million, assuming everyone pays, but you know that 3% of people are going to pay, but you can buy it for 2%. So you play the arbitrage, you make a little bit of money, and because we know that most people refi every 5 to 7 years, and that's kind of what he's talking about. But this is pretty interesting that the purchasing of these is a thing, and that also can be a hedge against inflation. I think that's what we get into next, if I'm not mistaken. How to prepare. Yes. So hedge. Definition of a hedge is to protect oneself against a loss on a bet or investment by making balancing or compensating transactions. Right? So how do we know this is happening. We don't want to have our money in the bank because we know our money's dropping in purchasing power because the government added water to the soup, and the soup is your wallet. So those people with tangible assets enjoy this, right? You're like, hey, I own stocks. Well, stocks will come back. Gold, guns, fuel, real estate is the biggest one. It's like, alcohol. Yeah, the world ends. So whiskey.
Got lots of it.
So you want to have tangible assets, including commodities, oil, iron, corn, soy. You know, the things that are inputs into other things. My favorite's buy rental real estate. I think it's still a great time to buy rental real estate. We're still building them and buying them, you know, as fast as we can because it's a hedge against inflation. It's a bet against what's happening, right? Like, hey, if I can get something at 6.5% interest or 5.5% interest that still puts money in my pocket, it's a good deal because you still have someone else paying the mortgage that's paying the debt off. You're able to depreciate the asset, saves you in taxes. You can write off the interest, and it's cash flow. So the simplest form of asset versus liability, I remember when I was maybe in high school, you guys remember Robert Kiyosaki, Rich Dad Poor Dad? He got just slaughtered. I think it was, I don't know, on multiple TV shows, you know, Jay Leno and late night shows, because he would say your house is not an asset. Because the simplest definition is an asset puts money in your pocket every month. A liability takes money out of your pocket every month. So the house you live in, based on this definition, is not an asset. Because what happens if you stop making that payment?
It goes away.
They take it from you, right? But if someone else is making the payment as a rental, they're putting money in your pocket every month. That's a good thing. So even in these times, if you can leverage, right? I take my $100,000, I could buy $1 million worth of my $100,000 and buy $500,000 worth of real estate that puts at least $1 a month after all expenses in my pocket. That's a fantastic hedge against inflation, and it's an asset. But if you buy a rental property and it loses money every month, it's a liability. So it's that simple. So invest in real estate, but understand that it has to be net positive after all expenses. And if it's not, don't buy it. And the simplest thing to think of is, how many things could I afford to own that made $100 a month? As many as I could buy. But how many things could I afford to own that lost me $100 a month? It's limited, right? It's gonna suck you dry. Other things, right? If you're like, hey, real estate's not for me, they're called TIPS. Treasury Inflation Protected Securities. You can go to treasury.gov and you can buy inflation bonds. They're inflation index bonds, and they will track with inflation to at least hold your money, right? So if you have $1 million and you're not interested in real estate, you can buy other things. And one of them is, so the same dingbats that have the 2.7 trillion they can't figure out how to get rid of also are going to sell you bonds that guarantee you that your money doesn't lose its purchasing power. It stays even. They'll probably sell those for a loss too, whatever. Gold, commodity stock like I talked about. What are oil stocks doing? Everything else is taking a dump. Oil's super strong because it's a commodity. It's needed. So, and in the stock market in general, like at the end of the day, there's going to be ups and downs in every market no matter what you're in. That's to be expected, like that first graph we looked at, right? Inflation, deflation. And so just know that there's always cycles. Everything has a cycle in it. Just don't, if you need to have some money in the bank, obviously, to make your payments, to have like emergency funds, but the rest of it needs to be working somewhere. It's got to be doing something for you. Otherwise, the mice are chewing on it in the bank, and those mice are little inflation mice. And then for our real estate clients, I just made that one up. It's pretty good, huh? What is this? 8. I have 8 pragmatic advices for you. If you're thinking about doing a buy-sell, right? I need to sell my house and I want to buy another one. Sell the one you're in first, and then buy. Because what you don't want to have happen is buy the one that you want and you can't get what you need to get out of the other one. You're stuck with 2 mortgage payments and you're in trouble. So that's the first thing. Do not buy before you sell. The second thing is don't set a I won't go below price. We may have to adjust our expectations, right? We thought our houses were $600. Your real estate agent said it was worth $525, and you said I won't take any less than $550. Well, just be realistic and understand that we don't make the market, we interpret it. And if you need to sell, you need to price it at a point that's going to make it sell. And the next one is the counter to that. Don't underprice it, expecting multiple offers to happen. Because the market has cooled down and volume has slowed down, just price your house right to make sure that it sells. And if you price it too high, that's what we're seeing. That's the 7% that we've seen kind of in real estate deflation. That's unrealistic people coming to reality. And actually, you guys are a great example of it. So we're looking at a place, I think they wanted 225. And then it hits 220. Like, yay, what's going on here? And then it hit 200.
Yeah, 200.
I'm like, okay, whatever, it's not worth it. Then they go to 180 in like 3 weeks. So when you do multiple price reductions like that, because it was never worth 225, they were smoking crack. Crack is bad. Then they get realistic, and everyone's like, "What's wrong with this place?" And it ends up selling for something stupid. But that's blood in the water, right? When you see, right, anyone that's looking on Zillow or Realtor.com, you see multiple price reductions. You're kind of like, I wonder how low they'll go. Whereas if you price it right and it sells in a week, then it's like, oh, okay, that must have been a good deal. I should have moved faster. That's the next one is react quickly to offers. If you do have an offer coming on a house that you're trying to sell, don't wait over the weekend. Just strike while the iron's hot. We had some people wanting to wait a couple weeks to get it listed. It's like, hey, list it today. I don't know what the future holds. I don't know what interest rates are doing. I know we got people interested now, so let's just respond. Whereas 6 months ago, you would wait to see if you could get 10 offers. Now it's respond quickly, just knowing that we have to be a little bit more nimble because it's turning into a normal market. Tip-top shape gets you top dollar. So keep your house nice, right? Keep your gutters clean. If there's peeling paint, paint it. Keep your house nice if it's up for sale. Yard mode, kind of the basic curb appeal stuff. Be patient. We're used to 3 days on market, 30, 40, 50, 60 days on market's normal. We used to take 12 months listings for a reason. It would take 9 months. to get an offer on a house. That was kind of in a recession, but 30 days on market's totally normal now. And if you've thought about selling, sell now and have a plan to know what you're going to do with the cash, because you don't want the cash sitting in the bank with those little inflation mice chewing on it. Right? But like, say you have a non-owner occupied place, you're sick of owning rentals, you just want to get rid of it. Now's a pretty good time to sell because it's looking like the market's flattening out. So if you do need to sell, don't wait, just make a move. The end.
Oh, I was just gonna mention to what you were saying too, with the 7% that are dropping. In the market that we were in for the last 2 years or so, we had to kind of price ahead of the market.
Yeah.
And so there's some people who are still stuck in that mindset, but now it's evening out, as we know, right? And that's why we're seeing that 7%.
Yeah.
That can definitely be a part of it.
So everything kind of looks like this. So here, and we still price ahead of the market. Here, you price ahead of the market and it's up. But here, you price ahead of the market and it's the other way.
Yep.
That's another thing we can say. Like, hey, if it is going to go down, like you need to be realistic and sell it. We used to do in 2011 when I got into this. It was still kind of going down. I was like, house is worth 150, but the price listed for 140. Because in a week it's gonna be worth 135. So,
That's pricing ahead the other way.
and we would. Okay, shit, I gotta sell it. I gotta get to Minnesota by Monday. Any other questions?
With inflation and interest rates obviously rising, correct me if I'm wrong, but just a thought I had is the people that can afford, they may not like it, but they're still gonna buy.
Mm-hmm. Yeah.
But it's also gonna force the people that thought they could buy to not buy, so therefore the rental market should still stay really strong.
Yeah. Yeah.
Because they may be able to upgrade a little bit to a nicer rental, so I would see, like, with the inflation and everything, rentals would still be really strong. Because like what we're noticing is people coming with offers, if they can afford it, the interest rate, they don't like it, they complain, but they're gonna do it no matter what.
Absolutely. And that's why new construction is great, because new construction, Steve builds a ton of new homes. He's not looking at what the interest rate is going to be on the next one, because you're building a ton of them, so you're just selling them. So that's going to be a steady flow. And what's happening here is in Oregon, you 10x this for the U.S. It's kind of funny. So we're able to produce 20,000 housing units a year in Oregon right now. The demand, that's how many people are coming here in Needham, is 30,000. And if we're going to catch up, because we're behind, we would have to produce 40,000 housing units a year. And this would be for 10 years to catch up, so we could go back to this. So we have a supply problem here, and that's also why this market's not like the last. 3.85 million homes on the market versus 1 million homes on the market. 650,000 brand new homes versus 285,000 brand new homes. So yeah, you're right. This is what we produce. So we produce 20,000 a year. The demand is for 30,000, and to catch up, we need to produce 40,000 a year. So until Oregon can figure out how to double the amount of new homes it builds every year, we're going to be in a situation where it is expensive to rent, it's better to own, and how does your house go down in value if very few people are selling and a whole bunch of people want to buy, and a whole bunch of people maybe aren't going to buy but need a place to live? So yeah, that's why one of the best hedges against inflation is buying rental properties.
Is that the same situation if we go into a recession?
Yeah, what
You
happens?
think rentals will still,
So this was, we pulled this for our Investing 101 seminar. So that was housing. The blue
2008.
line is like real estate
Prices. You see it?
and the red line is rentals. So
Yeah, there was a couple years where it flattened out, where this line flattened out, but it's never gone down. Because at the end of the day, housing is a basic need. Well, for most people, except for the hobos that live in the bushes over there. But for most of us, we need a place to live.
Really popular in Oregon.
Yeah, it looks like The Walking Dead sometimes in the morning.
And in your,
You guys need coffee?
your trash area.
Yeah, I gotta lock up
I'm
my
not gonna
trash
lie, Bear
cans.
Creek looks pretty enticing right now.
Yeah.
It's flowing clear right now. River, creek front property.
We talked about where prices are leveling out, and we're watching MLS, and 19 of the 20 listings today where price drops.
Mm-hmm.
How much longer do we anticipate that to happen? I mean, where is normal? Like, let's put it in a monetary price per square foot. I mean, what is realistic for an average? And maybe that's a bad number to ask, but I mean, I feel like we're just at the beginning of normalization. So how much lower do we expect this to go till we're normal?
You know, I would say probably 6 months.
Yeah.
Because there's, it's like some people like sleep under soundproof rocks
Right.
and pop out like, I'm gonna sell my house. It's a hot market. They're like, well, it is hot, but
Pure fact.
so until like, right, you have like consumer sentiment and homeowner sentiment and buyer sentiment. They kind of, right, buyers are kind of like, freaked out right now, right? Because we had like that. I showed a little dip graph. They're still kind of like, hey, geez, maybe rates are going to come down. My lender said I should wait 6 months. So there's like the 7 stages of grief, right? Like you're mad and you're in denial. And at some point you get to acceptance. So we kind of need like the general market to get to acceptance, new normal, right? Where they're not crazy. And you're always going to have people doing price reductions. Like we work with buyers and sellers, and there's always the people that think it's worth way more than it is. And you're like, all right, I'll put it on the market and you'll find out why. Blood in the water happens, you get low offers. So I would say 6 months. But that also means that like because we have low inventory and we at least know what rates are now, 5's kind of normal. Is that fair to say? 5? 4.5, 5.5, depending on what you want to do. The people that have gotten to the acceptance phase are buying and selling. And then you also have, is there something funny back there you'd like to share with the class?
Delwood.
He's a freak.
But that's not a fair market to new construction versus somebody that's occupying a home wanting to sell it, because I feel like in new construction, the price, because there's no such thing right now as affordable building. There just isn't.
Yeah,
and
it's
so
stupid.
we're building at such a high cost of materials and demand, so therefore our prices are set right. We're working way harder than we ever have to make the profit that we're making.
Mm-hmm.
But like a occupied home wanting somebody to sell an occupied home, they're just shooting, like you said, theirs popped out of a rock. I love that analogy.
Soundproof rock.
And yeah, soundproof rock. Interesting. But they just pop out because they had a dream in the middle of the night to sell their house because they could make $100,000 extra.
Yep.
But the reality is they probably should have been at $50,000 extra. I feel, and maybe I'm wrong, but like I would see like the used market would slow down, whereas the new construction should still kind of stay steady because of the demand for housing.
Yeah, it's the waves of ambition crashing on the rocks of reality with people that currently own homes. But yeah, new construction sales are a function of cost. Like we're not going to sell this for less than we're going to do it for, period. So yeah, and new construction historically has been more expensive than existing homes. And we just got to a point kind of where like existing homes and new construction were the same, which then fueled a bunch of people to buy. It's like, hey, they're 2,000, I'll take the new one over the used one.
Yeah.
Right? Unless this one has a view or a pool or something.
So what happens with the new construction game if rates go up to 7 or 8 or 9%? And people are like, damn, that house is nice. It's $600,000. What do I do?
We have a lot of rentals.
Yeah,
And it would
I
just
mean,
be tailored to the people that can afford it.
that's where the big boys are going to do well. Like, yeah, we'll
Yeah.
rent it out for 2 years. We'll ride the wave. But highly leveraged onesie twosie guys that are like, if this doesn't sell in 2 months, I can't make the payment anymore. They're going to drop the price until it sells.
And move to another state.
And yeah, you know it.
You mentioned earlier, like, rent increasing, especially, like, here with, like, with the Bill 108, where...
SB.
Yeah, and how it's kind of
608.
capped on what you can rent things for, but with inflation it increases. I think that was super interesting. I was asking Mike, for investment loans, are they going to put arms on those? Because if you're buying an investment property and you're kind of capped on what you can rent it out for, how are you going to keep up with the rising interest rate?
No, 7. It's 7. You guys, the rent control bill everyone's squealing about. I think it's 7%.
Yes.
Plus, what's our basket of goods called?
CPI.
Consumer Price Index. So if we're at, this is at 8%, and I can raise it 7 plus 8, which is 15. Yes? Nice.
Good.
Can I keep up with inflation and use a rental property as a hedge?
So, with the pandemic and our lovely state of Oregon that said, well, gosh, if you can't afford it, you don't have to pay your rent. I mean, I don't have any rentals, so I don't know how that played out with people that owned multiple rentals. If they had people in them that, whether they could afford to pay it or not, a lot of these people just said, nah, we're not going to pay rent.
I've got 34 and I had one.
Okay, so it wasn't a huge impact then.
Yeah, I had one not paying and I had one that was 2 weeks behind consistently. You know, but they all had money in the bank. They were getting, you know, so it was like, and then there's also like a landlord assistance fund you can get into, and then you could apply for government stuff. Like I tried to apply for it, and they're like, all right, how many people are behind? And I was like, ooh, that's a bad question. And then the application stops.
I think so. I'm sorry, go ahead.
Go for it.
I think some of that had to do with like where your rentals may be as far as like the price points too. Because I have had stories of family members that lost, you know, $7,000 or $3,000 based off of people not paying.
Well, that one was $1,450 a month for 17 months.
Yeah.
I mean, it ended up being, you know, I don't know, 20 some odd $1,000, but that goes back to like good practices, right? You run your business well, you pay attention to your clients. If you own a convenience store, you watch the store, make sure your employees aren't eating your profits or stealing or giving to their friends or doing incorrect change or stealing people's debit cards, credit cards. We had that happen at coffee shops. You treat your rentals like a business. I keep them clean. If something breaks, I get it fixed. If the roof leaks, it's taken care of. We drive by and make sure there's not trash accumulating. So part of it is don't be a slumlord and treat your rentals like you would your convenience store, your business, or your work, or your desk at your office, and treat it with respect and make sure you're responsive, and people then say, hey, this is a nice place to live. I want to stay here and I'm going to pay my rent. But if it's a shithole and the roof leaks and there's mold in the bathroom and the toilet doesn't flush, then they're going to be more likely to not pay rent because you're not running the business well, and then you kind of get what you get.
I would add to that, I have a lot of friends that rent right now, and
Shut up, Siri.
people who rent also know how rough the rental market is, especially in this area. No one who started renting even like 3 or 4 years ago wants to even attempt to move because of the rent control laws. Their rents have not gone up nearly proportionate to what that property could rent for now if they moved out. And if they were to try to go find something else, they'll be looking for housing at least, like most of them, at least double for what they currently pay for the square footage, bedrooms, bathrooms, stuff like that. So
You can't even find it.
you can't find it if you can. It's too expensive.
It's like, okay,
So,
oh no, okay, me.
a little bit of mutually assured destruction there. Like, yeah, you take care of your tenants, you take care of your properties, but also like tenants know if they stop paying and they have to go somewhere else. Like the no kicking your tenants out thing, they knew that was going to end at some point. If they get kicked out, they won't be able to afford to go anywhere else.
They're over in the bushes. Yeah, so does mutually assured destruction. That's the going, right? Like if you nuke me, I nuke you.
Mm-hmm.
Yep.
I'm gonna live in my bar.
Just make sure you chop
That's
the
not-
tires. All right, well, thanks everyone for coming. Anyone else have questions or comments? You're free to leave. I don't want to keep everyone. I respect your time. Hope you learned something. And at the end of the day, like I'm not selling anything today. I hope that we give good advice, and that when the time comes that you do transact with the team, right? If you're going to buy, you're going to sell, you're going to work with us. And if you want to meet with me and you have questions about, investing in real estate or buying or selling, like that's really what this is about. Like, hey, I build them. I'm a 7th generation builder. I own them. I buy them, I sell them, I live in them. Like, real estate is in my blood. That's all we've done, and that's kind of what we created this business about. Is at the end of the day, we want to make sure that we're providing value to our clients and to the community. I've got a finance degree and a degree in economics, and I love this stuff. So it's really interesting if I can learn something and gain insights and then give it to others that makes everyone's lives better, help you understand the way this stuff works, and then we do business. That's kind of what this is all about. So there's not no cloak and dagger at the bottom of the stairs, but if you need anything, just
I might be waiting for you.
Yeah, Dane. Last.
Somebody asked what's the article on Axios called?
Oh yeah.
Let's see. How do I get that to you? I have it pulled up here.
Why don't you?
You can tell me and I can
just
type it
can you
in.
email it to yourself real quick?
Control C. Oh, that's not how you do it. You got any more beer in that cart, buddy?
Oh, yeah.
Happy hour continues.
Yeah. Hey, that's not gonna last. All right.
And if you guys want the slides, my email is K-A-T at 541sold.com.
It should be CAT, but
Yeah, where did K come from?
My
Catherine?
grandmother.
With that, the 20,000, 30,000,
Yeah.
40,000 new homes needed,
yes.
will the Keep Oregon Green Initiative Act, will that, do you think Salem will play ball and allow us to change density zoning and create more housing to get even to what we need to be targeted at?
So there's two types of affordable housing. You have lowercase a affordable, which is what the market will bear, which is what builders build. They don't like that. They like capital A, which is subsidized by the government. That's what they're going for.
Okay.
They're going for the type of housing that does not play into a free market. It is, you need the government. You must come to us for everything you need. We'll give you your masks. We'll pay your rent. That's what they're going for. So we're trying to figure this out. How do we keep it affordable? And it's like, oh man, maybe we should go look at other states that have affordable housing and see what they do. They have open land use laws. They don't have psychotic permits and development processes. So Oregon has created this problem, but the problem is it started in 1970 with Senate Bill 100. And that's when you have state-controlled land use. This is the only state in the 50 that has the capital control what the entire state does. Every other state, the counties decide how many houses to build, how much land to develop. Salem does. And Salem does not like you driving cars, and they don't like people making money, so they want everything subsidized. And that's what they're legislating.
Yeah, or do you want
And that's why 73% of Oregonians think that we're going. And all of our rural residential, and they just let us divide one lot off of each parcel. So I have 80 acres. I can cut 5 off and build another house. Our housing problem would go away. But they won't let go of the land. We brought 2,700 acres into the urban growth boundary here, and a third of it's unusable. It's like cliff face. And then another 20% of it's dedicated for green space and parks. And the rest of it's going to take 10 years to actually turn into building lots we can build on. And they don't want us to do that because you have to drive your car to get there. So they want us all in town, but there's nowhere to build in town. So that's why.
Demand's going to work out pretty well for us then.
Yeah, that's why we can do 20. We need to do 40. And there's no end in sight. Did it work?
Yeah. Thanks, Abby. Put it in the comments.
Yeah, thanks, guys. Good job, Well, yeah, Al. So I'm doing these every month, so we'll send an e-vite out again. You can let your friends know if too many people show up. We can do it outside or something. We can do like a sermon on the mountain. We can figure it out. But,
Thank you very much. If there's an option to save that.
yeah, let me know if you guys have questions. We can do ideas or whatever else you want to talk about.
Did you commented it, right? Yes. Yeah, that's the comment. So I'm just gonna.
Thanks for not accepting or no. Very good.
This is Cassie. Guys, on Monday.
Yes.
Adam, thank you. Talk to you tomorrow. I sent you a text too. Just get back to me about it like tomorrow or something.
Yeah, check your. Did you DocuSign that offer?
Everything's done. They did.
Already did. Sick. Okay, Ethan's on it.